A very good morning, friends. First of all, welcome you all to the revisionary sessions on CA Final financial reporting. Well, I guess financial reporting is one of the core papers of final, and I think today we are starting with a very interesting and I would say the core standard in terms of the course. I always call it as a pillar in terms of financial reporting, financial instruments. It's one of the most interesting and I think the most important, I would say, topic which is always asked in exam. Invariably, we can't think of the examination paper without the presence of financial instruments in the paper. So we are going to revise the concepts of financial instruments. So what my strategy is going to be, I'll first of all take a quick recap of the concepts, what you've learned in financial instruments, followed by the practice questions. The idea is, of course, to practice more, picking up questions related to the past examinations or from the RTPs or the study material, a mix of questions, what we're going to do. But I think first I'm going to make a quick recap of the concepts and then proceed with the question so that we are absolutely in tune, in sync with the concept. So I hope the strategy works. If there is anything else, you can just let me know in the chat. I would be happy to hear if there is anything else which can be added to give you more value additions in terms of the revision. So I think let's begin with the journey. And I'm going to first make some quick mind maps to you, and then we'll proceed with the revision. Now, as you already know, financial instruments is three standards. One is Ind AS 32, which talks about presentation. One is Ind AS 109, which talks about recognition and measurement. And one is 107, which talks about disclosure. So I'm going to start the revision in terms of Ind AS 32, which talks about the presentation. So let's begin first of all, quick revision in terms of Ind AS 32, which talks about financial instruments, and that is presentation. So let me first try to recall the concepts, the important concepts in terms of the presentation of financial instruments. The moment you hear the word presentation, what should click to your mind is that I am looking at a presentation in the balance sheet of the company. So I think the first thing which you should always recall is that you're looking at the presentation in the balance sheet of the company, and typically we're looking at from the issuer point of view. Typically, I would say we're looking at things from the issuer point of view. So what I'm going to do at the first instance, just recall that what is the presentation which appears in the balance sheet of the company as an issuer. So let's look at an extract balance sheet to recall the inputs. So if I were to make an extract balance sheet focusing on the equity and the liability side, so this becomes my equity and the liability side. So as you already know that when you present the balance sheet, of course, it starts from the asset side of the balance sheet. But since we're looking at an extract balance sheet, the focus is on the equity and liability side. So this is my balance sheet extract. So I'm just first putting the headings out here. So we've got equity, which comprises of two elements, equity share capital, as well as other equity. And then you've got liabilities, where if I focus on the non-current liabilities, you get what is called borrowings, and that is supposed to be financial liability. Now, just to recall, you would remember that there are typically three kinds of instruments from the issuer perspective. Either you classify it as an equity instrument, or you classify it as a compound financial instrument, or it is classified as a financial liability. So we just want to reconnect that if it is a financial liability or equity instrument or a CFI, how are you going to present it in the balance sheet of the issuer? So when you say that it is supposed to be a pure equity instrument, then undoubtedly it is equity share capital. But if you say it is supposed to be a pure financial liability, then it is presented under borrowings in the balance sheet of the company. But when you say it is supposed to be a compound financial instrument, so when you say that it is supposed to be a compound financial instruments, you would recall that we do a split accounting, and on that basis, the financial liability element is presented here, and the equity component is presented as a part of the other equity. So I think this is one thing which you should easily recollect. So if it is an equity instrument, it is presented under equity share capital. If it is a financial liability, it is presented under the borrowings, non-current liability. And if it is a compound financial instruments, we split the two parts, the equity and the financial liability. The financial liability is the borrowings, but the equity appears as a part of the other equity. And I think just to reconnect once again, when you present this other equity, the balance sheet is accompanied by another document which is called SOKI. That is a statement of changes in equity. I presume that you would have already seen the main lectures as well on the ICAI YouTube channel, where you would recall that SOKI is divided in terms of three tabs. I always tell that it is divided in terms of three tabs. The tab 1 is the equity component of CFI, the tab 2 is the reserve and surplus, and the tab 3 is the other comprehensive income. So this equity component of CFI appears as a part of SOKI, that is tab number 1. So this equity component is going to appear as a part of the tab number 1. Now, since we are talking in terms of presentation, I think that was the first thing which should come to the mind, that I need to be very clear in terms of the presentation, that where these elements are presented on liability, rather would say equity liability side of the balance sheet being an issue. Okay, so far so good on this. So this is one inputs done. Now let's go further. The second thing what comes to the mind is the crucial issue, the parameters on the basis of which you decide that are we going to present the instrument as equity, liability, or a compound financial instruments. So I'm just going to revise the three steps which we apply in terms of deciding the instrument is what nature. So I think I'll call that as mind map 1. This was just a quick basic revision of the presentation part. Let's, I think, first make the mind map number 1. So I'm just going to number them as well. You can make your value additions later. Once you make your revisions, you can make the value additions further as well. So when you're looking in terms of identifying whether the instrument is equity, financial liability, or CFI, we just need to apply some concrete steps. So let me just remind you that how do we decide on the basis of a simple 3-step model? How are we going to make a decision that the instrument is what nature? We're just going to apply a simple 3-step model in this case. The focus number 1, the step number 1 is to identify the issuer has a contractual obligation. So if you recall the very first step, the step number 1 is, does the issuer have a contractual obligation? Does the issuer have a contractual obligation? And I think as we revise this, let me also pinpoint one thing, that these kind of things, what we're doing right away could help you a lot in terms of MCQ. You may not see questions typically on this area which are pretty lengthy, but when you look at the MCQs, you'll see that all this, the weightage of Index 32 focuses more in terms of MCQ. Of course, it can be asked otherwise as well, but if I just look at the past trend, then you can see that this insight is going to help you in terms of asking MCQs. So the focus number 1 is to decide that does the issuer have a contractual obligation? And when you say the issuer has got a contractual obligation, there are two possibilities. Either we say a yes or we say no, there is no contractual obligation. So I think the focus, of course, is on the word that the obligation has to be contractual in nature. To remind you, when you say that the obligation is contractual in nature, for example, when you say that there is a liability to pay taxes, it is not a contractual obligation. The liability to pay taxes is supposed to be a statutory obligation. So it fails the step number one. So at the first instance, you need to be careful in identifying the obligation of the issuer has to be contractual in nature. I always tell people as a clarification, which I like to remind you back out here. For example, when you study Index 37, Index 37 focuses on what is called a legal obligation, of course, a constructive as well. Legal obligation is by contract and by law. So you can say the legal obligation is a larger term because legal obligation includes by law as well as by contract. But Index 32 focuses on a contractual obligation. So it's a part of the legal obligation because legal will include law and contract. But in terms of 32, it is just a contractual obligation. So I think that focus should remain. So when you say no, there is no contractual obligation, undoubtedly, the standard is not applicable. Financial instruments would not apply. And if you say a yes, then it's time to go to the step number two. That is one first simple step which you need to keep in mind. The second step which we need to consider, once we've identified the contractual obligation, we go to the step number two in this particular case. And the most important thing, you always need to keep in mind is the mode of payment. Once you establish there is a contractual obligation, the second focus is always in terms of the mode of payment. Because how you are going to pay is deciding factor whether it is presented equity liability or a CFI. Now, when you consider a mode of payment, without getting into too much technicalities, we can say basically two modes of payment. Either we make a payment in cash or we make a payment in shares, or we can say it could be discharged by way of goods and service. The contractual obligation of the company could be discharged in cash, could be discharged in shares, or it could be goods and services. So we can divide this in three parts. The mode of payment could be in terms of cash. The mode of payment could be in terms of shares. Of course, we're making a mention on the equity shares. Or the mode of payment could be in terms of goods and services. Now, first thing which should be very clear in the mind that if the mode of payment is goods and services, standard does not apply. Because the two modes of payments are cash and shares. So, for example, let's say we consider there is an advance payment you receive from a customer. Now, when you receive an advance from a customer, there is certainly a contractual obligation. But that contractual obligation will be discharged by way of goods and services and not in form of cash or in the form of shares. So the moment your mode of payment is goods and services, we need to consider that the standard is not applicable. And I think receiving advances from customer is a good example. So all these, when you receive advances where you're contractually obliged, but you're going to give goods and service. Another example could be a case of warranty obligations. If I look at a company giving a warranty obligation, undoubtedly it is a contractual obligation. But the company will discharge the obligation by way of goods and service and not in cash, not in terms of shares. That would be another good example of saying financial instruments would not trigger. Now, when you say that the mode of payment is cash, you need to be very careful at this stage. And I've always said in the main lectures as well, that in this particular case, when you see the mode of payment is cash, many people jump to the conclusion and they say, okay, if the mode of payment is cash, it's a financial liability. No, you need to be careful that if the mode of payment is cash, there should be an unavoidable obligation to pay cash. We will call it as a financial liability only when there is an unavoidable obligation to pay cash. So you need to see certain terminology which is used. Obligation can be divided in terms of two components. When you look at the obligation of the issuer, it can be segregated in terms of two elements. One is the return, and one is, you can say, the principal. When I say the return is in the form of interest, or the return is in the form of dividends. So you need to now identify the terminology. So if you want to say, I think let me put that very clear in the chart. So I would say, if you say that it is a financial liability, the return needs to be mandatory in nature. The return needs to be mandatory in nature. You've got a dividends and interest which is mandatory in nature. If you say principal, it should be redeemable in nature. To call the return element as a financial liability, it needs to be mandatory. To call the principal component as financial liability, it needs to be redeemable. And if you say it is equity, that would be when it is discretionary in nature. When it is discretionary in nature. And the principal is supposed to be irredeemable in nature. So the moment you see the mode of payment is cash, you need to keep these generic terms into your mind. That if you say it's a mandatory return, it's a redeemable principal, it's financial liability. If it is discretionary return or irredeemable in nature, it's an equity instrument. So remember that the key point, what you need to keep in mind is, when the mode of payment is cash, you need to ultimately prove that there is an unavoidable obligation to pay. When there is an unavoidable obligation to pay, only then it will become a case of a financial liability. So that's the key point which you need to keep in mind. Then your focus comes in terms of, if the mode of payment is shares, we go to the step number 3. So this was step number 2, which is one of the crucial points in terms of deciding the nature. That means you need to consider very carefully what is the mode of payment. Further, we come to the step number 3. I'm just trying to recall the crucial concepts in terms of Index 32. And as again to remind you, well tested in terms of MCQs. Larger questions, of course, would be in terms of 109 generally. That's a disclaimer. Looking at just the past historical trend of the question papers, that's just a statement based on the trend. It's not any confirmation of any inputs. Now, in terms of the step number 3, when you say the mode of payment is supposed to be shares, now that's where many people go wrong. And I think that's what we need to be careful on. If your mode of payment is shares, you need to first of all identify the contract is derivative or non-derivative. And that's where, many students at times make a mistake. Because when the mode of payment is cash, the assessment whether it is derivative or non-derivative is not required. But when the mode of payment is shares, you need to first make an assessment that is the contract derivative or is it non-derivative, or sometimes it can be a blend of derivative and non-derivative as well. So in this case, your first thought should be to segregate. In this particular case, I would say the first thought in this particular case would be to identify, is it supposed to be a derivative or is it supposed to be a non-derivative? So we need to decide, is it derivative in nature or is it non-derivative in nature? Now we need to recall that when is it supposed to be derivative in nature? Immediately your mind should tell you that there are a total of 3 parameters, and I've got a tendency of telling every time 3 steps, 3 elements, and that's just a chance. So you should be able to recall that derivative has got 3 parameters. Any one parameter is not met, it's not a derivative. You need to meet all the 3 parameters to call a contract or an instrument to be derivative in nature. So what are those three parameters? Let's recall. So when you say that it is a derivative, you need to meet all these three conditions. So you need to meet all these three conditions. So let's make a focus. You need to meet all these three conditions. So what are the conditions? Let's recall. The value of the contract depends upon an underlying asset. The settlement will be done at a future date. There is no initial investment or negligible initial investment. Because, for example, in terms of options, we do have some initial investment in the form of option premium, but that's a negligible amount when you compare it to the contract value. So the three features are: the value depends upon underlying asset. The value depends upon the underlying asset, because derivative, as you know, is the word, it derives its value from an underlying asset. That's one. Second, settlement at a future date. The second one is a settlement is done at a future date. And the third is, as far as the initial investment is concerned. As far as the initial investment is concerned, it's either nil or it is negligible. So once you meet all the three characteristics, then it becomes derivative. Even if a single characteristic is missing, it is non-derivative in nature. Now, once you've filtered that it is derivative or non-derivative in nature, then we need to decide the kind of test. If it is derivative in nature, I think I should be putting some questions in between as well to you, but I'm intentionally not putting questions at the start when I'm making a revision of the concept. Once we start with the practical practice, then of course I'm going to put questions to you as well. So once you say that it is a derivative, we need to apply what is called a fixed test. I've written for, it is for, so written as short as for. It is called fixed for a fixed test. And when you say it is non-derivative, you are supposed to apply what is called a fixed test. And here we need to be careful in terms of the factor that what is fixed in nature. If it is non-derivative in nature, you are focusing only on the number of shares to be issued in the future. So we just need to see the number of shares which will be issued in the future. So in this particular case, if the number of shares is fixed, then it is supposed to be equity instrument. And if the number of shares is variable, then it is supposed to be a financial liability. So in terms of non-derivative, your focus is purely on looking at the number of shares. Is the number of shares to be issued fixed or variable? Accordingly, we decide it is equity or financial liability. Next, if it is supposed to be a fixed for a fixed test, you need to see the number of shares as well. And you also need to see the consideration as well. So two elements are we seeing, the consideration as well as the number of shares. The consideration to be received against the allotment of number of shares. The consideration to be received against the allotment of number of shares, the both factors need to be seen. So in this particular case, if both are fixed, so in this case, if both the factors are fixed, the number as well as the consideration, it becomes an equity instrument in that case. In any other combination, when I say any other combination, that means both are variable, one is fixed or one is variable, then it becomes a financial liability in that case. And I think the most common examples in terms of derivatives, which you would recall, the most common examples of derivatives are three. You enter into a forward contract, you enter into a futures contract, you enter into an options contract. So these are examples of pure derivative instruments which have got all the three characteristics as mentioned. Okay, so I think now we can collect the dots. The mind map one, the crux in terms of IS 32 stands in front of you. So we have basically, made a simple three-step input. I'm just going to take a quick recap with you in a minute to just, I think, connect the dots out here. Okay, so I guess let me just come back on the agenda and let's, I think, do a quick recap of the concept. So the focus is when you're looking at India's 32 presentation in the balance sheet, and the presentation as per the Schedule 3, Division 2, equity is equity share capital, liability is borrowings, and if it is CFI, split accounting, equity in the other equity, and liability is a part of the borrowings. What are the parameters? I made a step number one. Number one, does the issuer have a contractual obligation? Focus is the contractual obligation. The obligation of the issuer needs to be by contract. The second focus is on the mode of payment. If it is cash, the bell should start ringing in terms of unavoidable obligation to pay makes it financial liability, otherwise an equity instrument. Your mode of payment could be cash or shares. If there is a mode of payment, goods and service, financial instrument standard does not trigger. And if it is shares, the focus is first on derivative, non-derivative. To decide derivative, we've got those three parameters. If all three parameters present, it becomes derivative. Any one parameter missing, it's non-derivative. Remember the test, if it is derivative, fixed for fixed test, you need to see the consideration fixed and the number fixed. That is equity, any other combination liability. In terms of non-derivative, we just focus on the number, that the number is fixed, it is equity, and if it is variable, it's financial liability. So I hope, friends, you're able to recall these concepts, just made a crux of the chart. I hope we're going at a good pace. I hope we are also going with the concepts. The strategy seems to be working. I think a little thumbs up or little message would help. I hope we're going absolutely in the right pace, trying to revise the crucial concepts in terms of things, trying to take the advantage of maximum in terms of the time. I hope it's working well. Okay, so let's now proceed further. So this is one element which is there. Great to get your message. Now, this is one element in terms of Index 32. But I think one of the most important element tested well very frequently in the exam is the concept of a compound financial instrument. So what I'm going to do, first of all, I'm going to make a revision of the CFI because I have created a list, curated a list of questions, and these are like super 20 questions which are there. I'll zoom it back. So these are questions where the journey starts from the compound financial instruments only. 20 questions containing, different examination questions, RTP or study material questions, which can flow, in a flow give you a quick revisions of the concept. So I'm making my mind map number two. I'm making my mind map number two, which is on compound financial instruments. So the first mind map was in terms of classifying the instrument from the issuer perspective. Now we're looking at the second mind map, which is from the perspective of split accounting. Let's first of all consider a generic revision on CFI. Then we can make a very interesting chart on a CFI based on the generic information. But let's first make a generic revision. So my second mind map is on the split accounting for a compound financial instrument. So my second focus is on the split accounting, which is for a compound financial instrument. Now we know this very well, that in terms of CFI, you need to divide the proceeds in terms of FL as well as equity. So we need to take the proceeds as a base. So when you take the proceeds as a base, the idea is to split the proceeds between the financial liability as well as in terms of equity component. So when we calculate the element of financial liability, the financial liability is supposed to be based on a present value, based on the present value of, you can say generally, I'm saying generally, the interest and the principal. So we can say that as an issuer, you need to see that there is an unavoidable obligation to pay cash. So we need to consider the present value of the interest and the principal. And I think the important element to be kept in mind is when you consider the present value, you need to consider a discount rate. And what is that discount rate which is considered? We need to consider the rate of interest on a non-convertible instrument, which of course is given the question. And I always tell people that if you're given the interest rate on a non-convertible instrument in the question, that is also indicative of the fact that it's a compound financial instrument in nature. So we need to consider a discount rate, which is, you can say, the interest rate, which is supposed to be the interest rate on non-convertible. It is supposed to be an interest rate on a non-convertible instrument. So that is one focus point, that you need to consider the interest rate on a non-convertible instrument and take the present value of the interest and the principal. That will give you the financial liability element. And of course, we get this as a balancing figure. As far as the equity is concerned, this becomes a balancing figure. The proceeds minus the financial liability, that becomes the equity element. Now, one crucial point. Once you have segregated the financial and the equity element, what is important is to watch out if there is any transaction cost which is given in the question. So I think there is one special issue which needs to be revised, that once you've done the split accounting, what happens if there is a transaction cost? So we're looking at the
in
when you reduce
progress.
it from the financial liability. Now tell me, when you will calculate the finance charge, will you be able to take the original discount rate which was used in a split accounting, or a new discount rate? I think that's a crucial question. So if you have considered the reduction of the transaction cost from the financial liability, now the question is, will you be able to consider the finance charge on the discount rate originally taken for the split accounting, or a revised discount rate? Let's, I think, get the inputs from your side. So in this particular case, when you will consider the finance charge, are you going to consider the discounting rate originally used in terms of the calculations, or a revised one? I think, let me answer that. You need to consider a revised discount rate on the basis of which the split accounting was done. Though I did not get any answers on that part. So I know sometimes we tend to forget what we have done, but I think since we are revising, my presumption is that you've actually, studied the topic well. So we're just running the concepts and we're just going to focus on doing the questions with you. Right, so far so good. So I think this is done. I've given you the insights on the compound financial instruments, split accounting, that's one focus. And if there is a transaction cost related to CFI, then in that particular case, dividing the TC in the ratio of FL and equity, FL portion gets reduced from the financial liability, and then a new discounting rate, and the equity element is adjusted against the retained earning. I think now we are in a position to do some questions with you based on this generic revision. So let's begin with a question with you on this now, on the compound financial instruments. Let me just, I think, zoom this to you. Let me know, friends, if this is visible. Otherwise, I'll share my screen on the laptop. Let me know if this is visible to you. Otherwise, I'll share the question on the screen of the laptop as well. Is that working well, or do you want me to share it on the screen? Is it visible, friends, to you? Not visible. Okay, so then let me just share it on the screen of the laptop as well. We can just, I think, read this. Nishita, I think you said I'm not able to see the video. I hope it's working now. You're able to watch the class, I guess. Okay, I'm now going to share the question on the screen. I'll just share my screen to you. We'll read the question from there. This is an examination question, and let's have a read out here. I hope that's visible enough now. So let me just read the question to you. So it says, we limited issued the bonds have got a life of 5 years and a face value 20, and they offer at any time in the next 5 years. The companies with a similar risk profile have recently issued a debt at the rate of 6% per annum with similar terms but without the option for conversion. And I think you would recall just a couple of minutes back, I made an observation that generally, if the question gives you the interest rate on a non convertible instrument, that is indirectly giving you a hint that this is a compound financial instrument. The company is paying a coupon rate, an interest rate of 4.5%, whereas the interest of the coupon rate on a non convertible instrument is 6%. You're required, number one, to provide the appropriate accounting entries for the initial recognition as per the relevant Ind in the books of the company. So he's basically asking for a split accounting. Then he says calculate the stream of interest expenses across the period of 5 years on the life of the bond. And then it says provide the accounting entries if the holder of the bond elects to convert the bonds to ordinary shares at the end of fourth year. Mind the words. The life of the bond is supposed to be a period of 5 years, but the third requirement is telling you that if the holder elects to convert the bonds at the end of fourth year, then what is going to be the position? So we've got three inputs in the question for 8 marks. One is the split accounting at initial recognition. One is the interest calculations across a period of 5 years, and the entries if the conversion takes place at the end of the fourth year. So this means the option is, of course, with the holder. So I guess let's begin with the input. So maybe you can just take a snapshot of the question in front of you before I proceed, I guess. So the question is there with you. So just keep it in front of you. I'll start the journey. I guess you would have taken a snapshot of this. I'm just stop sharing the screen and I'm going to start over the question with you. Okay, so keep your calculators ready. You need to do some calculations to me. So we're working on the question number 1. So in terms of the split accounting, this is a generic question. So we are considering, first of all, the proceeds. And I guess you can, now this is to be split in terms of the financial liability element. So we can get the equity as a balancing figure. So all what you need to do is present value of the interest and the principal. Now, let me ask you a simple question further. Based on the information in the question, can I clearly say that it's an optionally convertible instrument and the option to convert is with the holder? Let's see, what is your observation on that? Is that a correct observation that it is an optionally convertible instrument with an option to convert with the holder? Do you agree with the observation? I'm just trying to draw the inputs from the data given in the question. The option is there. He's converting the debt in terms of the fourth year. And I think that's rightly agreed. So let's consider the financial liability elements. So we are going to pay interest on 75 lakhs and a 5 years factor. 1 divided by 1.06, 1, 2, 3, 4, 5. I think it comes to 4.212. Then the principal redemption, that would be at the end of the fifth year. I think it's 0.747. Just see if the PVIF and PVIFA is right or not. And let's multiply this. 75 lakhs into 747, 56,02,500. I think it's coming to a total, I guess, 70 lakhs 24,050. Just vouch me if this is right or not. And then we can take the balancing figure that's coming to, I think, 475,950. So if you take the balancing figure, it is 4,75,950. This becomes the equity component of the CFI. Right, I think I made the calculations. I was waiting for people to give me the questions as well. So this is the proceeds, that is the financial liability, and that is equity. Now, what does the question says at the beginning? It says provide the appropriate accounting entries for the initial recognition. So he is focusing on the journal entry which is to be done at initial recognition. So the question is very clear that I want a journal entry in the books of the issuer at the time of initial recognition. So I think we can comfortably put the entry. So that is going to be bank gets a debit, and that would be to the extent of 75 lakhs. Then you can consider putting the name as convertible debt, convertible bonds, but I'm directly recording financial liability and I'm recording the equity. So the split accounting gave you the figures. This is 70 lakh 24,050. This is 475,950. That is the initial entry done. So the first part of the question stands done. This is the requirement number one, which is done. Given the split accounting to the examiner on the basis of which you put the entry for initial recognition. Now coming to the second requirement, calculate the stream of interest expense across all the 5 years. Now, the calculation of the interest can be done in two ways. Either you make an amortization chart or you make a ledger account. Either ways you can get the answer. I'm just going to make a ledger account for the ease of convenience, because in any case I need to answer the third part where the option to convert is exercised at the end of fourth year. So to make it simple, I'm going to use the approach of making a ledger account to identify the interest elements. So let's go to the second requirement of the question. So let's make a ledger account for the financial liability element. So we've got the financial liability element. Let's put the entry bank. The liability element is 70 lakh 24,000. 70 lakh 24,050. That is the amount. Now you are going to consider the finance charge. Are you going to consider at 4.5% or at the rate of 6%? Let's at least get that. So when you're going to consider the finance charge in this particular case, are you going to consider the interest at the rate of 6%? That's absolutely correct. So let's take a 6% interest on 443. Then there is a payment which is made at the end of the year. Now, when you're going to make a payment at the end of the year, that has to be at the contracted rate, which is 4.5%. So let's see what is the interest payment on 75 lakhs. There is a 4.5% interest. That works out at 337,500. So we can get the balance CD as a balancing figure that closes the ledger for the first year. Now we can just do the exercise for the next 4 years as well. So let's see what is the balancing figure to begin with. And this becomes a balance BD next year. I'll just make the ledgers second year, third year, fourth year. We need a fifth year as well. We'll do that. So this comes to 70,24,050, 421, 443, and 337,500. So this is, I think, 71. This is 71 lakh 7,993. 71 lakh 7,993. Now let's start computing the interest again. So let's take the finance charge at the rate of 6% on this. That comes to 426, 480 approximately, rounded of the interest. And again, we make a payment which is 337,500, and we get a balance CD as a balancing figure. So then it becomes quite mechanical indeed. Once you're able to achieve the initial calculations, then it becomes easy. 71 lakh 96,973. 71 lakh 96,973. Again, consider the finance charge at the rate of 6%. That's 431,818. We can make a payment. That's bank. That's 337,500. You get the balance CD as a balancing figure again. 71,96,973 plus the interest. This comes to, I think, 72 lakh 91,291. 72 lakh 91,291. Again, we consider finance charge at the rate of 6% on this. That works out at 437, and that is 477. We again make a payment, that is 337,500, and we get a balance CD as a balancing figure. So I think this works out at 73 lakh 91,268, because the third requirement is a conversion at the end of the fourth year, but I think still we need to focus on the interest. 73 lakh 91,268 cash. Just to close the ledger, I'm considering that the payment is made in cash. So we made a payment of 337,500. I think that's a personal issue. I didn't get a message. 73, 91, 268. This is coming to 446, 232. That is the finance charge. Am I audible to you, friends? I think I didn't get a message. Somebody sends me, I'm not able to hear you. Am I audible? Can you just send me a message? Yes, wonderful. I think then maybe I think you have some internet issue. Okay, so the interest calculations are done. This answers the second requirement of the question. Now there is another third requirement where it says I want the entries if the holder elects to convert the bonds at the end of the fourth year. So I think the ledger for the fourth year is ready. I think we are in a good position to do that. So let's go to the third part now. So we are coming now to the third part, and that is we want to make the financial liability ledger again. This is fourth year. So you can take the data from the previous part. That's the easier way to do it. And that is the reason to calculate the interest expenses for various years, I did not make an amortization chart. As I said, there are two alternatives. You either make an amortization chart or you consider a ledger. I think making ledger becomes a little more easier task. So let's consider the fourth year data from the previous part. So that is 7291. That is 7291 291. And we've got a finance charge, just copying it. 437 477. 437 477. Now, in this particular case, what do we need to do? First of all, of course, we pay the interest. The interest, of course, is going to be paid. So we're going to pay this 337 500. The interest is paid. Now the bondholder says, I want to convert this in ordinary share. So we are very clearly given the bonds are supposed to be convertible into how many shares? It says that they will be converted. It says, I think let me just share that on the screen as well to you. Back to the question for conversion figure. So it says out here, the bonds are issued at the face value. Each bond can be converted into one ordinary shares. Now, if you look at the number of bonds, we give it that the total face value of the bond is 75 lakhs and each bond has got a face value 20. So the company has got a total of 3,75,000 bonds. And the question says that we're going to convert each bond into one ordinary share. So that means equal number, that is 3,75,000. So I think let me just come back on the input. So in this particular case, I'm just calculating the number of bonds. So we're given the company's issued bonds of 75 lakhs with a face value 20. So there are 3,75,000 bonds. So we are issuing one share for every one bond. That's the instruction which is given in the question. So we're going to issue 3,75,000 bonds. So in this case, what do we do? So we will write down equity share capital. So we are going to issue 3,75,000 shares, assuming the face value is 10. Assuming the face value is 10. So we're going to issue 37,50,000 of the share capital, that is face value. Can you tell me what is going to be the balancing figure in this particular case? So can you tell me what is the amount? Not the amount, but where are you going to take the figure? Because there is a difference which is appearing in this ledger. So where are you going to take the difference in terms of this ledger? I think let's put that question to you. So this is the face value of the equity shares. So where are you going to take the difference, the balancing figure? In the meantime, let me just calculate the balancing figure. 72, 91, 291, 437, 477. So we're getting a balancing figure. This is to the extent of 36, 41, 268. And that's rightly said. It's going to be taken in the share premium account. This money will be taken in the share premium. The money over and above the face value of the shares will be taken in the share premium. But there is another element which is also present, and that is the equity component of CFI. The question also arises at the end of fourth year, if the bondholder says, I want shares, what do you do with that equity component? Even that equity component will be taken to the share premium. So let's make a mention out here. So as far as the equity component is concerned, which is there in tab number 1 of SOKI, that initial segregation, this will be transferred to the tab number 2, that is share premium of SOKI. Because share premium is also part of the tab number 2. So this element will also be transferred. So you should make a mention to the examiner that the amount which is the equity component of CFI is going to be put in the share premium in the tab number 2, because that money will now push to the tab number 2, that is share premium. Okay, so far so good. That was a pretty easy question indeed, if you ask me. That was quite a warm-up exercise, what you've done. Let's go further. Okay, so I guess we are going to take another question with you. Some questions meant for your revision, some questions I'm going to take it. So I'll share another question to you. This one is done. We'll take another examination question. I'll share another question to you on the screen. So let's have a look at another question. Let's look at the question number 2. I think one more question on CFI before we go further. This is November 19 examination question, which came for 10 marks in the exam. So you can see the frequency of asking questions in terms of compound financial instrument is quite good. It says we issued 80,000 convertible debentures, 100 each on 1st April 15. The debentures are due for redemption on March 2019, which is 4 years, at a premium 20%, convertible into equity share to the extent of 50%, and the balance is settled in cash to the debenture holder. The interest rate on equivalent debenture without conversion right is 12%, and the conversion to equity qualifies as fixed for fixed. Now, when it gets qualified as fixed for fixed, that means it is supposed to be equity element. And you are required to separate the debt and equity components at the time of issue and show the accounting entries at initial recognition only. I think that's really good. The examiner is focusing the entries only at the initial recognition, no subsequent accounting required. The idea of doing this question is a little different. Because through this question, I am interested in making a certain chart. I don't know if it is the right time to give you another insight and make another interesting summary chart on different types of compound financial instruments. What do you say? Shall we first do this question, then create a chart, or shall we first create a chart and then do the question? I go with the majority choice. What do you want me to do? Because I am having something in my mind. The idea of doing this question, because there are various kinds of instruments: optionally convertible, partially convertible, mandatorily convertible, that's compulsorily convertible. So what happens to each of these instruments? What happens to the equity component? What is taken in the financial liability elements, etc., etc.? I guess there were no suggestions coming in, so I think I need to go with my flow. So I think let's do this question. Once you do this question, then I think we'll make a chart after this particular question. So let's begin. So I'll just share the question once again on the screen. You can maybe take a snapshot to begin with. That's examination question, November 2019, 10 marks in the exams. So once you've taken a screenshot, I think let's begin the journey. I'm just going to stop sharing the screen. Let's begin. So we are on the question number 2. So I think first of all, do the split accounting. So in this particular case, we are very clearly given one very important information. The debentures are convertible after 4 years, but they are redeemable at a 20% premium. So let's begin with the split accounting. And we're not required to do any accounting for the next 4 years. We're just required to do the initial recognition, split accounting. That's it. No complications required. So I am given, as far as the proceeds are concerned, so we are very clearly given about the proceeds. The company issued 80,000 debentures of 100 each. So this is 80,000 debentures, 100 each. I guess that comes to a total of 80 lakhs. And then we need to consider the financial liability to get the equity component. And I think at this stage, I am definitely interested in putting across a question to you at this particular stage. So my question is pretty simple and straight. Are you going to consider the entire interest and the entire principal to calculate the financial liability, considering that 50% of the money is convertible in terms of share and 50% is in terms of cash. So when you consider the financial liability element, are you going to consider the full interest? Screen is not visible to me. I just reshare it once again. The question. See if that is visible, I guess. You can take a snapshot, then we can proceed further. So when it says that they're convertible into equity share to the extent of 50% and the balance is settled in cash. So my question remains further out there. In this particular case, when you consider the financial liability, are you going to consider the entire principal or only 50% of the principal? Remember, 50% is payable in cash, 50% is payable in share. So can I say this is something like a partially convertible debenture? So when you go to consider the financial liability, will you consider the entire principal or 50%? I'm yet to get an answer on that. That's rightly said, it is 50%. So let's do the calculations of the financial liability. Then we can get the equity as a balancing figure. So I am given that 50% of the principal, but that is at a premium of 20%. So 80 lakhs redeemed at a 120% value, but we will take only 50%. This 120 is for the premium, and this 50% is the principal amount. This is going to be paid at the end of the fourth year. So I think for that, the factor is already given in the question itself. That's 0.625. And then we consider the interest on 80 lakhs. We take an interest at the rate of 8%. That is for the next 4 years. So I'll take the cumulative factor at 12%, 887, 788, 701, 625. I think it's coming to 3.001. So I think the only crucial point which we need to keep in mind is that we are considering 50% because it is supposed to be a partially convertible debenture. So we need to consider 50% of the principal. So let's do the calculations. This is going to be 80 lakhs, 120%, 50%. That's 30 lakhs. I guess it comes to 49 lakhs, 20,640. So we get the balancing figure, that is equity. That's, I think, 30 lakhs 79,360. That becomes the equity element. So can you please share the question bank PDF? Yeah, that would be shared in 80 lakhs. Financial liability gets a credit to the extent of 49,20,640. And the rate, considering 10 marks, wow. Okay, so I think the compound financial instruments, basic revisions done. Do you want me to make a summary chart on different kinds of compound financial instruments and understanding what is the element of financial liability? What is the treatment of the equity component of CFI at the end? Would you like me to make that chart? If you say yes, I'll make it. If you say nothing, I'll not make it. And just one yes will not make me happy. I need to get a flooded yeses to make this. The incentive is more people ask me, then I get incentivized to make it. Just one person says yes, that doesn't incentivize me. Okay, now we get a 2 yes on that. Okay, so I think just 2 people want it. The rest of the people say that they will say yes, we will get it. I think you need to ask for it, friends. Okay, anyway, we'll make the chart for you, but I want a little more active participations at your level, because once you give answers, you learn more. So an active participation on your part is going to be great. Still only two yes on that. Okay, so anyway. So let's make an interesting chart so that we can close index 32 at this end. Because after the compound financial instrument is done, we get a switch over in terms of index 109, where the focus is on a lot of things. Financial instrument has got a lot of things to do. So I am making an extended chart of the mind map 2. This is a summary chart, which is a part of the extension of the mind map 2. The extension of the mind map number 2. The second mind map was on the compound financial instruments. And I'm just making an extension chart in terms of compound financial instruments to you. So this is on the concept of CFI. So I'm just going to create a simple little inputs on the different kind of CFI. Once the chart is done and you go back and make your revisions, you'll be able to relate it quite well, because there are a couple of questions in the study mat in the past examination questions, which gives you a whole lot of things: optionally convertible, mandatorily convertible, partially convertible, and all these kind of stuff. And there is one more instrument, and that is supposed to be in perpetual debt. So I'm putting 4 columns. I'm putting a total of 4 columns. 1, apart from the particulars, 2, 3, and 4. So I'm going to show you different kinds of compound financial instruments. So one is a perpetual debt. What is a perpetual debt? So where the coupon rate is less than the market rate. I think if you've seen the regular sessions, you would remember that when the coupon rate is less than the market rate, it becomes a compound financial instrument. And if you've seen those regular lectures, you would recall that when the coupon rate of interest is less as compared to the market rate of interest, it becomes a CFI. Then I'm looking at optionally convertible. Then I'm looking at optionally convertible instruments. Of course, the option is with the holder. Then I'm looking at partially convertible. I'm looking at partially convertible, and I'm looking at mandatorily convertible. I'm looking at mandatorily convertible. So I've got 2 focus points at this particular stage. The 2 focus points which are there with me is in terms of the calculation of the financial liability. So when you do the split accounting and you calculate the financial liability, there are 2 elements. One is the interest and one is the principal. So we want to consider that, are you going to consider the interest and principal both, or which element will be taken or not? And I want to understand, secondly, that what is the treatment of that equity component? What is the treatment of that equity component of CFI at the end? The money which is taken in the tab number 1 of SOKI, what is the treatment of this? Now, I'm not going to make this short since it's a revisionary lecture, so it's important for me to put some questions as well. So I want your active participations on this particular chart as well. So let's begin the journey. So I am looking at, first of all, the interest element. Are you going to consider the interest in a perpetual debt? When you go to do the split accounting and you take the present value of the interest and principal, so are you going to consider the interest? Definitely yes, that's right. And are you going to consider the principal? It's, remember, a perpetual, that means an irredeemable debt in this case. And that's why we said no. When you consider optionally convertible, I think the question which we did November 2018 was on that optionally convertible debt. So I think I can answer that. We will consider both the interest and the principal, and we are considering 100% of the principal. And the next question which we did, which was on November 2019, that was on this question. So I think I'll just like to make a mention. This was on November 18 exam question. And this is what we did was November 19 exam question. They've also taken mandatorily convertible as well. Okay, and now let's consider if it is partially convertible, we definitely took the interest and the principal. But what portion of principal? Convertible or non-convertible? Because it was 50% convertible, so we could not really identify that the principal which you took was convertible or non-convertible in nature. And that's right, we are going to consider the portion which is non-convertible in nature. Great. And what about mandatorily convertible? Interest will be taken, but what about the principal? And that's right, nothing will be taken in terms of the principal. Since it is mandatorily convertible, I've got no obligations to pay the principal. So you need to be very clear in terms of the split accounting that whether the interest and the principal elements are taken while computing the split accounting financial liability. Now let's turn the focus to equity component. Can I say since this is perpetual debt, can I say it will continue to be a part of tab 1? It will continue to be in tab number 1. This money will continue in tab number 1. It is supposed to be a perpetual debt. What about optionally convertible? If it is optionally convertible, the person may ask for cash, the person may ask for shares. If the person says, I want cash, where will you transfer that money? If you've seen the regular lectures, you would easily recall. Good. So this is going to be taken in the capital reserve. And if you opt for shares, you've just seen it goes in share premium. Wonderful. Okay, let's go to the next one. If it is partially convertible, of course it is shares. So where do you take that money? If it is supposed to be partially convertible, then where do you take this money? So if it is partially convertible, this will again go to the share premium itself. Okay, so that is great. So now let's go to the mandatorily convertible. So in terms of mandatorily convertible, you're again going to get shares. So can I say this money will also go to the share premium? So the money in this particular cases goes to the share premium. So I think this is one crucial point. So now if you see, along with the mind map number 2, I have given you two basic insights. Number 1, if there is a TC relating to CFI that was taken, and I've given you a comprehensive summary chart which tells you different kind of instruments in this case. I guess I can also tell you for a mandatorily convertible instrument, I think if I rightly remember, there has been a question which came in the exams that was in June 2019, I guess. So you can see, the kind of questions coming in the exams. November 18, optionally convertible, June 19, mandatorily convertible, partially convertible, November 19. So almost like every attempt you see questions coming in this trend. So that was a trend, historical trend which occurred. So you want me to do a question on a compulsory convertible as well? This is the only area, or can I skip that and go further? That depends upon your choice. Because I've done this. So do you want me to do the question on June 19? It's there in the Super 20 questions. You want me to cover that question as well? In the absence, I'll presume a no. If you say yes, I presume yes. Some people saying yes, some people saying no. So I get one yes, I get a no. So one more vote that decides the fate. Okay, we can maybe discuss it fast. Instead of doing that question, I think we can just discuss it fast. This is question number 3. We just, I think, discuss it without doing that question. Let's, I think, quickly discuss the agenda. So I am given in this question number 3. This is the June 2019 question. It came for 12 marks in the exam. It says perfect issued 50,000 convertible, compulsorily cumulative convertible preference shares on 1st April 17. It says the rate of dividend is 10% payable at the end of every year. The preference shares are convertible into 12,500 equity shares of the company at the end of fifth year from the date of allotment. When the CCPs are issued, the prevailing market rate on debt without conversion option is 15%, and this time we've got a TC as well. Wow. And it says the effective interest rate is given. So as I told you, once you are given a TC, the finance charge has to be computed based on the new effective interest rate, which is already given in the question, and the discount rates are defined. You're required to compute the liability and the equity component and pass journal entries for the entire term of the arrangement. That is from the issue of preference shares till the conversion into equity shares, keeping in view the provisions of the relevant index, that is index 32. So in this particular case, we'll just quickly connect some dots. So I think one thing is very clear, that in this particular case, you do the split accounting. So let me put two quick questions to you at this stage. When you will do a split accounting, will you consider which coupon rate? Because we are paying an interest at the rate of, it says 10%, whereas the coupon rate on a non-convertible instrument is 15. So let me put that first question to you. In terms of the split accounting, will you split at what rate? 12, 15. And that's right, we'll split it on the basis of 15%. After splitting at 15% and dividing the TC, the unwinding, or you can say the finance charge in the financial liability, will be at what rate? 15 or 15.86? And that's right, 15.86. So I think it seems to be quite manageable indeed. So I think we'll skip that part. So I think I'm not doing that question unless you still decide otherwise, the final call. So we are not doing this question. You said it's manageable, then I'm leaving that question, right? Okay, now there is another interesting special issue which is there relating to compound financial instruments. Manageable. Okay, wonderful indeed. Now there is another interesting element which is there in terms of compound financial instruments, that's called early redemption or early repurchase. So you want me to just give you the concept, a quick revision on that, or you want me to do a question? I'm first going to give you a revision. In the meantime, you can give your inputs. So there is a little special issue which is there. There is a little special issue which is there pertaining to what is called early redemption. There is early redemption of compound financial instrument. There is early redemption of a compound financial instruments. So if you know, I'll just make a quick mind mapping, a flow charting kind of a thing, which will keep you intact in terms of index 32 after this. So in the meantime, you need to decide that are we doing a question on this particular part or just the conceptual revision is okay. So your video is not visible. How come it's not visible? I guess, is everybody able to see me? It's already on the spotlight. So maybe your internet could be giving a little problem. Am I visible to all? Is the visibility fine? Yes, it's visible. Maybe I think your internet could be, troubling you. Okay, now let's come to the input in terms of early redemption. So one is at the initial recognition. You do a split accounting. And in the split accounting, the proceeds are segregated. The proceeds are segregated in terms of financial liability as well as equity. So in this particular case, when you issue a compound financial instruments, the split accounting is done. The proceeds are in a usual manner segregated in terms of financial liability and the equity. The financial liability is then you create a ledger, and this amount remains in terms of the tab number 1, and there is no change. And there is no change. Now, what happens when there is an early redemption? Now, what happens when there is an early redemption in this case? You need to again do a split accounting. The day when the early redemption of a CFI takes place, you are required to do again a split accounting. So we repeat a split accounting on the date of early redemption. But in this case, when you do a split accounting, what is the discount rate you consider for the financial liability? Can I say you need to consider the interest rate which is prevailing for the remaining maturity? If I just like to show you the connects in terms of the question, let's have a look at the question number 4. That's an RTP. That's a question which came in the RTP that was in November 2021. I'm just reading the facts of the case, which is on the special issue of early redemption. It says, I'm just reading in between, the company issued a 9% convertible debt. I'm taking a jump and going to a line, third, fourth line. The non-convertible debt, the interest rate is 13%. And then I'm going a little below further when it says at the date of repurchase, the company could have issued a non-convertible debt with a 2 years maturity at the rate of 10%. So let me put some 2 quick questions to you at this stage so that we stand at a common census. My question number 1, at the time of split accounting, which one will you consider? At the time of split accounting, which coupon rate will you consider for discounting? We issued the convertible debentures at 9%. The non-convertible is 13. That's right. So you will consider 13%. And on the date of early redemption, which coupon rate are you going to consider? 13 or 10? On the date of the early redemption, you're going to consider which rate? That is 10. That's great. So I'm just coming back on the agenda. So at this time, when you repeat the split accounting, you need to consider a new discount rate. And you need to consider what is the rate on non-convertible. You need to consider what is the rate on a non-convertible financial instrument with same years to maturity. With same years to maturity. In this case, it is 10%. That's the important call. That you need to repeat the split accounting, consider a new discount rate, which is a rate on a non-convertible instrument with the remaining years of maturity. And you will get the financial liability and you will get the equity component based on the split accounting. Now the quick question goes to you. You will now compare the book value of the liability and this new liability, and you will get a difference. You will compare the value in the tab 1 and this value, and you will again get a difference. So the question rises, where will we take this difference? So can I say the difference which arises on a financial liability will be taken in the P&L. That's a gain or loss which arises on an early redemption of the instrument. So this difference will be taken in the P&L. But as far as the difference in the equity component is concerned, that would be taken in RE. So let's get the connects very clear. So if there is an early redemption, you need to be careful. An early redemption would mean you first did a split accounting, segregated the FL and the equity portions. You continue to prepare the financial liability ledger, and the equity component remains the same in tab number 1. Then on the date of early redemption, repeat the split accounting using a new discount rate and compare this liability versus the book value difference in P&L. Compare this equity versus this equity, and the difference enters the retained earnings of the company. You want me to do the question based on this, or do you think it's manageable? So if you say manageable, I'll go to the next area. If you want me, I'll do the question. Somebody again screen is not visible. Oh my God, there seems to be a lot of internet issue. Please relog and I think that might solve the issue. So you want me to do a question on this area, or do you think that's manageable with the conceptual knowledge? I'll go with the majority. Silence would mean that it's manageable, then I'll push forward. Okay, I did not get any input so far on that. That means it seems to be manageable. So let me just make a quick mind map. Then we can proceed to Index 109 on that area. Okay, so let me just first make a quick inputs on this area. So what have you learned in terms of Index 32? So what is the main, I'm just making a quick flow chart to get the connects that what is the key areas which you need to keep in mind when you're looking in terms of Index 32. So just brief one on, okay, I think we just take a brief then in that case. Because I keep asking whether I should do it or not. Most of the people are silent early in the morning. You need to be active, friends. So I need your active participation. So tell me, you want to do this question? Yes or no? Accordingly, we'll take a call. If you want me to do it, I'll do it. If you think it's manageable, that's fine. But at least give me yes or no. Yes, I think I get a yes. So let me just make a quick mind map on this. Then I think we'll proceed on this. Great. So first, I think let's make a little flow chart in terms of the key issues which you need to keep in mind as you revise Index 32. I've just tried to make a crux of the situation. Now see, what's this carefully. So when you revise Index 32, I think the two key issues which should immediately crop to your mind, as I started with, you should be clear on the balance sheet presentation. You should be very clear with the balance sheet presentation with reference to financial liability, with reference to equity, and with reference to CFI. And I think I've already done that. I'm just making a quick flow charting to help you better make your concepts clear so that everything is crystal clear. So when it comes to financial liability, it is a part of the non-current liability and it becomes a case of borrowings. When it is equity, you present it in equity share capital. And when it is compound, you do the split accounting and it is shown as a part of the equity share capital. Sorry, it's shown as a part of the other equity. It is shown as a part of the other equity as well as the financial liability. The second agenda which needs to be very clear is the three-step model. The second agenda which needs to be very clear is the three-step model where we've got certain focus points. And the focus points, what we've got is, the focus point one is the contractual obligation. That is one focus point. The second focus point is the mode of payment. And the third focus point is deciding it is derivative or non-derivative. And accordingly, if it is derivative, applying a fixed for fixed test, and if it is non-derivative, applying a fixed test. And that is one input what we done. Then we went on further. And thereafter, we entered into another area of discussion, and that was the area of compound financial instruments. That was the area in terms of compound financial instruments. And in terms of the compound financial instruments, the clarity which you need is the concept of split accounting. And for the split accounting, I've already given you a summary chart. In terms of different types of, which is based on different types of CFI. So this chart is already there, which gives you a clarity in terms of different types. So that should be a mapping in the back of the mind. Secondly, we're looking in terms of the special issues. And there are two special issues which you need to be clear on. One is the concept of treatment of TC, which we discussed. the treatment of transaction cost, which we discussed, that needs to be clear. And the second is the case of early redemption. The second is the case of what you call the early redemption. So I think this is what needs to be very clear. This is the final, I would say this is the final mind map or the flow chart, which has to be clear. If you're able to cover up these areas well, Index 32 is completely mapped in your mind. You will be able to understand that what is the flow of thought, how the presentations are done in the balance sheet, what is the criteria of identifying the nature of the instrument, and then considering the split accounting for various components and the TC and the early redemption. Okay, so far so good. So I think let's now proceed. I can do another small, further mind mapping. So in this case, we did the question number 1, 2, 3. I guess I'm just mapping that part as well. I did the question number 1, 2, 3, and this was question number 4. So question number 1, 2, 3 was on this area, and on the early redemption, we've got the question number 4, which is the. I hope this chart helps. Now we are just going to do a quick discussion, as we said, on the early redemption, and then we'll close Index 32 with you. So let me share the screen back again, and we'll just have a look at the question number 4 once again. We'll just make a quick run through. It says in question number 4, on 1st April X1, PS issued 6,000 9% convertible debentures with a face value 100 each, maturing on 31st March X6. The debentures are convertible into ordinary shares at a conversion price 105 per share. Interest is payable annually in cash. At the date of issue, non-convertible debentures would have been issued by the company at a coupon rate of 13%. Then it says on 1st April X4, that means 3 years later. The convertible debentures have got a fair value of 6,30,000. PS made a tender offer to the debenture holders to repurchase the debentures for 630, which the debenture holders agreed to accept. At the repurchase, the company would have issued a non-convertible debt at 10%. So we are required to do the entries on initial recognition and at the time of repurchase. So I think let me put some quick questions to you. If you can vouch me, I think we are sorted on this question. Number 1. Can I say at the first instance, you will do a split accounting where you will consider both the interest and the principal, yes or no? This is a case where it's not a partially convertible or a mandatorily convertible. So we go with the simple presumption that this is supposed to be a case of optionally convertible instrument. So can I say we will at the first instance consider at the time of split accounting principal and interest both discounted at what rate? The coupon rate is 9 and the non-convertible is supposed to be 13. That's right. Next. Can I say you are going to make the ledger account for the financial liability for how many years? Once you do the split accounting, get the FL, you're going to make the financial liability ledgers for how many years now? Because the total period is 5 years, out of which 3 years have passed by, and then the early redemption takes place. So you're going to make the financial liability for how many years? I guess 3 years, right? Equity components, of course, will not undergo a change. Now, let me put the next question. On the date of repurchase, are you going to consider 6,30,000 as the proceeds? On the date of early redemption, are you going to consider 6,30,000 the repurchase price as a proceeds? Still waiting for the answer of that? Yes, of course. And then you will segregate the financial liability and the equity using which coupon rate? 630 becomes the proceed, and then you consider the remaining interest for 2 years and the principal and discount it at 10%. Then I think you know the drill. You're going to compare the financial liability in the books after 3 years versus the financial liability in split accounting difference in the P&L, and you're going to compare the other equity element, it goes in RE. I think that was a quick discussions on that concept. Okay, so far so good. I think this is done. So we are done with Indus 32. So that brings me to the discussion, the end of the discussion in terms of Ind is 32. Now I think it's time to give you a quick break, and then I think we want to focus on Indus 109. Time is limited, and we've got a couple of things to discuss. So let's give you a 10-12 minutes break, and then I start with you on the journey on Indus 109. Any questions, friends, at this stage? Thank you, sir. Good discussion. You're most welcome. So I think any questions in your mind? Otherwise, we'll take a 10-12 minutes quick break and then we commence back and start the journey in this 109. Another interesting in. Okay, I think so far so good. That seems to be good. Let's take a break, friends. We'll join you after the break. Thank you. So I hope you had a relaxation of mind and a quick recap of what you learned in Indus 32. Now we are focusing on the next core element of financial instrument, that is Indus 109. Now just to reconnect, Indus 32 was focusing more on the issuer perspective, where you learn the parameters of classifying the instrument from the issuer perspective and the accounting for a compound financial instrument. Now, when it comes to Indus 109, the focus shifts first of all to the holder, where you learn the art of accounting for financial assets and the accounting for financial liabilities. Apart from that, the concepts of derecognition of financial assets and financial liabilities, and certain special issues in terms of impairments, in terms of embedded derivatives, as well as the concept of hedging. The journey is pretty long indeed. So as usual, what we're going to do, we're going to take some quick recap of the concepts and then we will do some questions based on that. So let's begin the journey. So my focus now is on Indus 109. And in terms of Indus 109, I'm first of all focusing on the holder, and we are focusing on the accounting for financial assets. The first focus is accounting in terms of financial assets. So let's first make a mind map number one. When it comes to the financial assets, the first thing what comes on the measurement aspect is what is the value at which a financial asset is initially measured and what is the value at which it is subsequently measured. So let's, I think, first make a mind map number one. So we're focusing in terms of the financial assets measurement part. So when you look at the measurement of financial assets, the measurement of financial assets can be segregated in terms of two parts, initial as well as subsequent. Subsequent, of course, means at each balance sheet date. Initial means when you recognize it for the first time in the books of accounts. Now, you would easily recall that initial measurement of all the financial assets is always at a fair value. But then there are certain exceptions where the financial assets are measured at a transaction price, and there are two exceptions. Number one, if it is a case of a trade receivable. When you make a sale and you recognize a trade receivable as per Indus 115, you consider a transaction price. And the second exception is a loan which is recoverable on demand. That is also recorded at a transaction price. Other than that, all financial assets are initially captured at a fair value. So immediately what comes to the mind is the initial recognition of the financial assets is always at fair value. Of course, we'll talk about the transaction cost separately, but this is always done at a fair value with the two exceptions which you need to keep in mind. And the two exceptions are, number one, if there is a trade receivable or there is supposed to be a loan which is recoverable on demand. The loan which is recoverable on demand. So in these two cases of exception, the initial recognition is at a transaction price. That is at a transaction price. Now, I think just to make a little mention at this stage, because that would also be another area of focus. So let's put it at this stage. Now, when you record the financial asset initially at a transaction at a fair value, so leaving the case of exceptions, there could be a difference in terms of the fair value and the transaction price, which needs to be captured in the books of accounts. Remember those areas of concession loan given to the employees, loans given by the parent to the subsidiary or vice versa, as well as any kind of deposits which are made where the differences in the transaction price and the fair value is captured. So when you're making the revisions, that tune should also get clear. So what I'm doing, just as a matter, I'm just going to put it across that immediately your mind should focus on the special issue. Your mind should focus on the special issue immediately, that when you look at this, so we need to consider the cases that when there is a difference between transaction price and fair value, then what is the accounting for those cases? I think that will tackle as a special issue, but I think it was necessary to put that in the mind map at this stage, that you stand clear that, okay, when there is a difference between a transaction price and a fair value, depending upon those special cases, we need to consider. Next, coming back to the concept of a subsequent measurement, if you've seen the regular classes, I have already given you that here the procedure depends upon a three-step model which I gave. And just to put the gist, either the measurement is based on amortized cost, or the measurement is at a fair value through other comprehensive income, or it is supposed to be at fair value through profit and loss. And in terms of OCI, there is R and there is NR, recycling or reclassification, no recycling, or you can say no reclassification. So all the financial assets subsequently are divided in terms of four categories, depending their debt or equity investments. And in this particular case, it is either measured at amortized cost or at a fair value through other comprehensive income, and it could be FPTPL. Now, the element of testing the financial asset falls in which category can be, generally is quite well tested in the MCQs. But when it comes to the larger questions, in terms of solving questions, that you get as a subjective question. So I think still we are catering, of course, to the MCQs as well as to the main questions as well. So I'm going to make some quick summary charts also, just trying to recap that what are the parameters on the basis of which the subsequent measurements are done. Let's just connect some quick dots at this stage. So when it comes to the measurement of financial assets, initially it is fair value with certain exceptions, which is at TP. And then we also consider that there are certain exception cases which is dealt as a special issue. Subsequent measurement depends upon the parameters which are given in 109, for which I'm just going to make a revision of the 3 steps with you. And that would decide the fate that you are going to measure the financial assets subsequently at what value. So let's now continue with this mind map, and let's focus in terms of the subsequent measurement. Let's focus on the subsequent measurement of financial assets. So we're looking at the subsequent measurement of the financial assets in this case. Now, if you've seen the regular classes, so why do you keep saying that again and again? Though they are revisionary classes, so naturally an implicit presumption that you've seen those sessions as well. So you would remember and you would recall that all the financial assets are either debt investments or they are equity investments. And typically there are 4 basic charts which you need to remember. The flow in terms of 3-step, if it is a debt investments, there are 3 business models. And if there are equity investments, then I would say there are 2 cases, held for trading or not, which we'll just pen down in the charts and revise. And there is also a concept of a derivative investment as well. So what I'm going to do, I'll go case by case. We will make those 3 steps for all different categories of investments. We'll make a walkthrough on debt. We'll make a walkthrough in terms of equity. We'll make a walkthrough in terms of derivative. So per se, I would say I'm focusing in terms of debt investments, equity investments, as well as derivative investments. So let's proceed. So in terms of subsequent measurement, I think let's make a chart number 1. Let's make a chart number 1 to make a quick revision on this. So let's make a chart to make it simpler. Step 1, then there is step 2, and then there is step 3. So putting this as step number 1, putting this as step number 2, and putting this as step number 3. So here the focus is on the equity investments. The chart number 1, the focus is on the equity investments. We'll draw some conclusions based on the chart as well. But first, let's make a quick running inputs on this. I am not putting questions to you in between so that the flow of the revision doesn't get disturbed. I'll be putting questions to you only when we do practical illustrations, but the conceptual bits I'll keep making summaries. I hope that works. Now, if you remember, just to recall that as a holder, you need to step into the shoes of the issuer. And you need to see that if the issuer says it's an equity instrument, then the holder says it's an equity investment. So your step number one is stepping into the shoes of the issuer. The step number two is putting a question to the issuer. The step number three is putting a question to the holder. So your focus needs to be clear in terms of step one. That's I'm putting in this chart only, that you step into the shoes of issuer. You step into the shoes of the issuer. In step number two, we'll put a question to the issuer. And in terms of step number three, we will put a question to the holder. And I think in terms of equity investments, you will also recall that when you put a question to the issuer in this case, this is called CCFC comprising SPPI test. So the step number two is supposed to be contractual cash flow characteristic comprising solely payment of principal and interest test, where you are putting a question to the issuer that is he going to pay you interest and the principal or not. In terms of the books in question to the holder, we are looking at what is called HFT. What is called HFT, that's called a held for trading test. So your focus needs to be clear. In step one, you step into the shoes of the issuer. In terms of step number two, you are conducting the CCFC SPPI test. And in terms of step number three, you're looking at is the equity investments held for trading. Now let's connect the dots. So when you step into the shoes of the issuer, so we would have realized that from the point of view of the issuer, it's an equity instrument. So from the point of view of the holder, it becomes what is called equity investments. What is equity instruments as per Ind is 32 for the issuer becomes an equity investments for the holder. Now, let's I think put that question. Maybe you want to answer that as well. So when you conduct this test from the issuer perspective, that on this equity instrument, are you going to pay me interest or principal? You know the answer. Are you going to get a yes or no? Of course, no. Because equity instrument means no obligation, no mandatory obligation, discretionary dividends, and the payment of principal only on liquidation. So this test will definitely fail. And when it comes to the step number three, then in this particular case, we need to see is it held for trading. So either we say yes, it is held for trading, then we said it is FPTPL. Fair value changes will enter the profit and loss. And if you say a no, then also it is FPTPL. Then also it is FPTPL. But in this case, we get a choice. And the choice is irrevocable choice. It's an irrevocable option where the holder may decide that I don't want to go for FPTPL, in which case he can go for FPTOCI. He can choose an FPTOCI, that is with no recycling, no reclassification. So you can see one thing very clearly, that as far as equity investments are concerned, by default, the measurement is FPTPL. And in this particular case, if you prove that it's not held for trading, you get an irrevocable option of choosing an FPTOCI NR. Now, another important input. When you look at equity investments, it's important to tell you that we're focusing on equity investments in related, unrelated parties. That's another input which needs to be clear. And let's make this also clear that as far as related parties are concerned, we apply the case of Ind AS 27. So as far as related parties are concerned, they are covered by the aspect of Ind AS 27, where generally, I'm saying generally, these investments are taken at cost, because Ind AS 109 is per se applicable for those equity investments which are made in unrelated parties. So I think that was important to mention. If you make investments in related parties, subsidiary, associate, and JVs, then all those investments as per Index 27 are taken at cost or fair value at the choice of the company. I think that makes sense now. So this is the chart one, that is equity investments. Let's make another one. So we make another chart as well, and this is debt investments. So we'll take step one and we'll take step two and step three. So this is my chart number two. That is my chart number two. And here I'm focusing in terms of debt investments. Here I'm focusing in terms of debt investments. So we're focusing in terms of three charts. One is equity investments, one is debt, and one is derivative, because these kind of understanding is very well tested in terms of MCQ. So classification parameters are important. Of course, when you do a larger question, then I think these parameters may not be very active in a question. So this is step number one. Then this is step number two. And this is step number three. Step number one, step number two, and step number three. Here again, I'm not putting those things again, but I think few changes. So I think I just make a slight mention. The step one, of course, is that you step into the shoes of issuer. That remains the same. And in terms of step number two, you put a question to the issuer. And in step number three, you put a question to the holder for an understanding perspective. So you put a question to the holder in this case. Now, let's first focus in terms of the two permutations combinations. So if you step into the shoes of the issuer, let's see what is the position from the holder's point of view. Now, as an issuer, you say it's a financial liability, then it becomes a debt investment for the holder. As an issuer, if you say that it is a compound financial instrument, then also it becomes a debt investment for the holder. So you need to remember that from the point of view of a holder, there are two categories of debt investments. What is FL is a debt investment for holder. What is CFI is also a debt investment. So we need to split our discussions in terms of these two separate areas. And let me also connect the dot. In this case, we are conducting the CCFC comprising the SPPI test. Same input. But in this case, it is not held for trading, but it is called the business model test. It is called the business model test. So the step number two for equity as well as debt is same. But the step number three for equity is held for trading, and for debt, it is supposed to be a business model test. So difference in terms of the step number three. Now let's focus. So in terms of the debt investments, if you look at financial liability, you will definitely pass this test. Because when I'm going to put a question to the issuer, am I going to get interest? Yes. Am I going to get the principal? Yes. He's got a contractual obligation to pay the interest and principal. I get the contractual right to receive the interest and principal. So you will undoubtedly pass the test. Now, there are three kinds of business model we can confront. Either we are planning to keep the investment till maturity, or we are planning to do a trading, or we've got a dual objective of either keeping it till maturity or we are going to trade. It can be a mixed objective as well. So if it is a case of maturity, it is amortized cost. If it is trading, it is FPTPL. And if it is dual, it is FPTOCI, and that is supposed to be recycling or reclassification. And you remember debt investments are always R. In case of OCI, equity investment is always NR in terms of OCI. And I think worth making a mention further at this stage. If it is AC, if it is supposed to be AC or FPT OCI, if it is AC or if it is FPT OCI, the company can alternatively choose an FPTPL, but this is not a choice. This is a conditional choice which is exercised only when you want to eliminate or reduce the concept of accounting mismatch. We've done the extensive discussions of elimination or reduction in terms of accounting mismatch, but this is a conditional choice. So when you fall in the AC or you fall in the OCI category, there is a conditional choice. There is a conditional choice which is to reduce or eliminate the accounting mismatch. So when you want to reduce or eliminate the accounting mismatch, so once this condition gets met, you can alternatively consider these investments at FPTPL. So in terms of equity, it was a pure choice, not based on conditions, but a management policy choice. But in this case, it's not a pure choice. In this case, if you prove that there is a reduction or elimination of accounting mismatch, then only you reach the inputs in terms of using FPTPL. Let's come to the next one now. That is the case of debt investments. Now, if it is a CFI, you will definitely fail this test, especially when you're looking at optionally convertible instrument. In terms of optionally convertible instrument, the holder may realize the returns either by cash or by shares. It's not solely, because the CCFC test comprising solely the payment of principal and interest. So the return is not solely in terms of cash, but it's a blend of either shares or cash. So this test will fail. And once it fails, there is no need of applying a step number 3. It is directly FPTPL itself. So this is the chart number 2, telling us the quick treatments in terms of debt investments, that if you got debt investments 2 category, you invested in a debt investment which is a CFI for the issuer, FPTPL. If it is a financial liability for the issuer, it all depends upon your business model, that what is the intention in terms of trading, maturity or mixed objective. That is the chart number 2. Let's proceed further. So let's now make a chart number 3. That is a simple chart, because in chart number 3, we are looking in terms of derivative investments. No questions asked. In terms of derivative investments, no questions asked. Because when you say it is supposed to be a derivative investments, it is simply FPTPL. So if you make investments in terms of derivative, it is simply fair value through P&L, so no steps to be applied in this case. So let's put the crux of the matter. Let's also put the crux of all the 3 charts put together, so we stand very clear on our thoughts. I just want to put a quick, you can say, crux of the chart. If I put a crux of all the 3 charts at a single go, then you would have said, why didn't you put the crux at the very beginning? But I think you need to know the revision in terms of the 3 inputs as well. Crux is only to do the major practical illustrations, but if you want to make a walkthrough in terms of the MCQ, you need to know this knowledge. So I would say, if I consider the crux, let's divide this in 3 parts. You've got equity investments, that is 1. You've got debt investments, that is 2. And you've got derivative investments, that is 3. So I'm looking at the crux of all the 3 charts put together in a single go, that if you've got equity investments, I would say, okay, let me first ask myself, is it in a related party or is it in an unrelated party? Is it in a related party or is it supposed to be in an unrelated party. Now, if you say it is supposed to be a related party, then we can say we are not applying Ind AS 109. So per se, in this case, we're applying Ind AS 27. And generally, the choice is there, but you can see that it is taken at cost. If it is unrelated in nature, the default category is FPTPL. That is the default category in terms of equity investments. And then we can just make a mention that in this particular case, if it is not for trading, you get a choice. You get a choice in terms of FPTOCI, that is no recycling. So I think that summarizes equity, unrelated default category, but you get a choice if it is not for trading. Certainly, when you look at the debt investments, it all depends upon the intention. It all depends upon the intention in this case. So we can say the intentions could be either it is maturity, or it is trading, or it is mix. If it is maturity, if it is trading, or if it is mix. So if it is maturity, it is amortized cost. If it is trading, FPTPL, and if it is mix, then it is supposed to be FPTOCI, that is R. And then you can also make a quick mention out here as a quick summary. So let's put an asterisk on AC as well as OCI. And we can make a mention out here. There is a conditional choice. There is a conditional choice on the basis of which we can use an FPTPL. So this is a free choice, but this becomes a conditional choice. And if you look at the derivative investments are always FPTPL. So they are always FPTPL. So you can see something very interesting in terms of the summary. Equity investments, FPTPL, derivative investments, FPTPL, and debt investments all depends upon the business model. So FPTPL takes a front seat in terms of equity, in terms of derivative, in terms of debt investment. It all depends upon the nature of the business model in this case. Right, friends, I think that was a quick summary in terms of 109 regarding the financial assets video. Now, what I want to do, I've got another interesting chart coming to my mind in terms of the entire accounting for financial assets from the initial to the subsequent measurements as well. So let's make another chart before we start with the practical illustrations with you, that what is the treatment of initial and subsequent measurements, including the concept of TC, where the concept of EIR applies. You want me to first make a chart or first do the questions and then make a chart? Because we've got the combinations of investments, like we've got debt investments in 3 categories, AC, OCI, PNL, equity investments in 2 categories, that makes it 5. Derivatives is FPTPL, that's fine. So you want me to first make a chart or do some questions at the beginning? First, we want to chart some questions at the beginning. We get a mixed response. One more vote. I think that could decide the fate of things, I guess. Okay, let's do, I think, at least a warm-up exercise. And I think let's maybe, consider doing one question at least to begin with. I've been making charts for quite some time. So let's, I think, have a look at least one question. I'm just going to share a question to you on the screen. You can maybe take a snapshot. Look at the question number 5. Let's have a look at the question number 5 now in this case. It says on 1st January, Tokyo bought 1 lakh rupees of 5% bond for 95,000, incurring an issue cost of 2,000. That becomes a transaction cost. Interest is in area. It says the bonds will be redeemed at a premium which is over and above the face value, and the effective interest rate is given. The fair value of the bonds are given. So now there are three requirements. I think I'm going to definitely put a question to you that in each of the three permutation combinations, which particular model would apply. Explain with calculations how the bond will be accounted for all the relevant years. Business model is to hold the bonds until redemption date. You can give me the measurement principle in this case. And that's right, it becomes an amortized cost approach. Great. The business model is to hold the bonds until redemption, but it says, but also to sell them if the investments with higher return becomes available. It seems to be dual objective, and that's right, it becomes a case of equity OCI, there is R. And then finally it says the business model is to trade the bonds in the short term. Trading means clearly FPTPL. And then it says assume that the bonds are sold on the fair value on January X2. Then he says the requirement to recognize a loss allowance on debt instruments held at AC or FPT OCI stands ignored. I think let's do this question. I think once we do all these three parts, I think the making the chart at that state would make a little more sense. So maybe you can take just a snapshot, then we can begin with this question. We'll perhaps make a chart later. That would be a better idea, I guess. Okay, so let me, I think if you've taken a snapshot, I think yes. Let's begin the journey. So this is my question number 5. And I'm looking at the accounting for debt investments. We're looking at the accounting of debt investments with 3 permutations and combination. I think making a chart after this question is going to make more sense because we'll be able to relate things better. I'll be able to put questions better. So we'll get the entire trail of thoughts. Okay. So first of all, I think let's take the case number A, which is amortized cost. So looking at the case number A, that is amortized cost approach. Now, first of all, when you consider the accounting of the financial asset, just remember initial recognition is at a fair value, but now we are also wanting to consider what is the treatment of TC, that is a transaction cost. So let's do one thing, let's make a ledger account. So I'm making a financial asset account, and we're going to first of all capture the figure that is bank. And I think it's worth making a mention at this stage. When you consider the initial recognition, it is at a fair value plus a transaction cost. In terms of amortized cost approach, the initial recognition is at a fair value plus a TC. So in this case, it is 95 plus another 2. That makes it 97. And by the way, let's put a small little question further to you. The interest will be captured at what rate? The contracted rate, which is given in the question to be, I guess, 5%? Or are we considering the interest at the rate of 8%? When you consider the accounting for a financial asset at AC, so we take interest at contracted 5% or EIR. And that's right, we're going to consider 8% interest. So we take a finance income at the rate of 8% on this. So 8% of this would mean 7760. And then you receive an interest at the end of the year. You're going to receive the interest at the coupon rate, which is on the face value at the rate of 5%. So we can take the balance CD as a balancing figure. That is year 1. I think it's a maturity of 3 years, so we can get the balance CD. And this is exactly, if I would make a mention, you would agree as well, that financial asset accounting is a mirror image of a financial liability accounting. The way you created a financial liability in terms of CFI, trust me, it is a complete mirror image accounting. So this is 97. 7760 minus 5, that's 99,760. This becomes the balance BD next year. We again record a finance income at the rate of 8%. That's approximately 7981. We again receive by bank, that is 5,000. Then we get a balance CD again as a balancing figure. 99,760, 7981. That's, I think, 102,741. That becomes a balance BD, 102,741. And as I maintained my inputs earlier, also we prefer to take the interest as a balancing figure in the last year. Though you can compute, but it's always safe that you get your answers rounded off. So we'll take the finance income as a balancing figure. Let's get the amount. You will receive 5,000 interest. And I guess as per the instructions in the question, if I take you back, the instructions in the question is clear. It says we're given that the bond is redeemed at a premium 5960 over and above the face value. So on 1 lakh rupees, there will be a 5960 premium. So you will receive 105,960. So let's get the finance income as a balancing figure. I think it comes to 8219. You can even make a cross check that is it coming approximately 8% on this or not. I think yes, slight little difference maybe. If you take 8%, it's exactly 8219. So this is exactly matching 8%, just as a cross check. So this is the input in terms of the amortized cost approach. I guess nothing special. So there are some key inputs which are coming to the mind so that we can put them in the chart later. The first is that you are taking the initial recognition at fair value plus a TC. The second is we are considering the interest based on EIR. And the third is we're not incorporating any fair value because amortized cost approach does not consider any fair value changes in this case. Great. Case A done. Let's go to the next one. So now we are on OCI. So that is case number B, where we are considering the debt investments. At FPTOCI, that is R. I think let me put a question to you at this stage. Are we going to apply the concept of EIR in terms of OCI as well? So will the concept of effective interest rate apply to the category of OCI also in this case? And that's right, yes. Many people get a confusion. I think it's important to clarify the concept of EIR is not applicable to equity investments. But the concept of EIR is absolutely applicable to debt investments except FPTPL. Equity investments, naturally, there is no interest. So the concept of EIR does not apply. But in terms of debt investments, the concept of EIR applies, leaving FPTPL. It applies to AC, it applies to OCI. So let's make a ledger account. So here also you need to remember one crucial point further. So let's take the financial asset. So when you take the initial recognition, the funda remains the same. The initial recognition in this case is going to be again at a fair value plus a transaction cost. That makes it 97. Are you going to capture the same finance income which you took in AC, by the way? Is the finance income for all the 3 years in this case remain the same, what you took in terms of amortized cost? Yes. So we'll take the finance income from the previous ledger. Right now we can compute. Otherwise, you can take the same figures, that is 7760. And we get the 5% coupon rate. And this time you cannot take a balance CD as a balancing figure, because you're taking a fair value through OCI. So your balance CD in this particular case is going to be at a fair value. So we have the fair value in the question. So the fair value is given 1,10,000. So we take this 1,10,000 fair value. So would you like to tell me where are you going to take the difference in this relation? This is a case of FVTOCI. So any difference is the fair value gain or the fair value loss, and that would be taken in terms of what? Correct. OCI. So let's see what is the difference balancing figure coming to. I think it's coming on the debit side. This is coming to 10,240. This is supposed to be a fair value gain, and that will enter the other comprehensive income. So on a very safer side, let's also recall another input as well. This fair value gain, can I say, will be taken in statement of changes in equity in terms of the tab number 3. And I would also like to, just recall another concept. Since it is a case of OCIR, can I say on the disposal of the investment, will this amount go to the profit and loss? Or will this amount be transferred to the tab number 2 directly to retained earnings? This is a case of other comprehensive income, that is reclassification. So on the sale of the investments, will you put this money in the P&L or directly in tab 2? Correct. So I think let's make a mention that on sale, it will be transferred to profit and loss account. So whatever is the accumulated balance, so we can say on sale, whatever is the accumulated balance in tab 3. So whatever accumulated balances are there in terms of tab 3, that money will be transferred to the profit and loss in the year of sale. Great. Let's, I think, go forward. So we get a balance BD. This is 1,10,000. Can I compute the finance income on this 1,10,000 now? Is it possible that I calculate my finance income on this money at this stage? Yes or no? And that's right, no, because this is the fair value. The calculation of the finance income is same what you did in EC. So I'll have to go back to the ledger and see the finance income is 7,981. So this is the finance income 7,981, worth making a mention. Same as AC. Whatever you've taken in the amortized cost approach, the same interest income is to be taken. And then again, we take this bank, that is 5,000. The balance CD will be the fair value. The closing is going to be the fair value again. So let's see what is the fair value at the end of the second year. I gave you, it is 1,04,000. So this is 1,04,000. So let's see what is the balancing figure in this relation. So 1,10,000, 7,981. It's coming to 8,981 on the credit side. This is a fair value loss that will also enter the other comprehensive income. Same lines, the third year would also be prepared. But technically speaking, this is a case when the company said that we might either keep the investments or sell. Let's assume that we did not sell. Let's make a third year ledger on the presumption they did not make a sale, because it is a dual objective, but sale is not a necessary prerequisite. So let's take the balance BD, that is 1,04,000. Finance income, you can see from the previous ledger, that's 8,219. And since we did not sell the investments, I'm assuming that you got the entire money on maturity. So if you got the entire money on maturity, 5,000 plus the principal including the premium, and there will still be a difference in the ledger. So we are getting a difference of 1,259. That is the balancing figure. This is again a fair value loss, which will enter the other comprehensive income. By the way, a small little quick reconciliation to get the fundas very clear. If you take this fair value gain and if you take the fair value loss, and if you take the fair value loss, just take the sum total of all these gains and losses which you've captured. The gain in the first year, the loss in the second year, and the loss in the third year. Is this total amount coming to zero? And is this by chance, or is this got to be? If you just look at the sum total of 10 to 40 gain minus the losses, is that coming to zero? Is the net gain or loss? Is the net accumulated balance in the tab number 3 at the end of the third year, is this coming to zero? Just see. Yes, that's right. And this is bound to be, this is 100% got to be, because you did not sell the investments. So ultimately, no gain or loss ever occurred. The unrealized gain never got converted to realized gains and loss, and therefore this is zero, because you kept capturing the fair value gain and loss, but you did not sell. So at the end, if you do not sell, the accumulated balance is bound to become zero in this case. Super. Right, so the case number B is done. Now let's go to the case number C, then we make a chart. So now we come to the case number C. That is a case of debt investments. That is a case of debt investments at FPTPL. So that is a case of debt investments at FPTPL. Now, one thing is pretty clear, as I made a mention earlier. The concept of EIR does not apply if it is FPTPL. So in this particular case, if it is FPTPL, the concept of effective interest rate is not applicable. I'll just capture the fair value changes, put them in the P&L, that's it. So let's, I think, instead of making any measures, let's look at things on a timeline. We made a purchase of the investments at time 0. I'm looking at the end of first year, looking at the end of second year, and the third year. So let's, I think, make a quick inputs on this. Your initial recognition is at fair value only. That's one crucial point. When you consider FPTPL, whether it is debt, whether it is equity investments, PC is not added. PC is added in all categories except the case of FPTPL. So TC not added. TC is not added. Then what do you do with the TC? It is charged to profit and loss account. In this case, it is charged to the profit and loss account. So the initial entry is financial asset gets a debit and bank gets a credit, and this will be at the fair value, that is 95. The transaction cost is not added on the initial recognition. Next. So we know the fair value at the end of the year is 1,10,000. The fair value at this stage is 1,04,000. And I'm given the instruction that it is sold at the end of the second year. So in this particular case, your investment was 95 and the fair value became 1,10,000. So can I say there is increase in the fair value, 95 to 110, 15,000 gain goes in the P&L. So we put the entry, financial asset gets a debit, profit and loss gets a credit. The gain, that is the fair value change, is taken in the P&L. Next year, I think if I ask you, there is a decline in the fair value. So first let's capture the difference. So this is going to be profit and loss gets a debit, financial asset gets a credit, and this is to the extent of 6,000. So from a figure which is 1,10,000 to 1,04,000, there is a fall in the fair value to the extent of 6,000. And now you can capture the sale of the asset. Will there be any gain or loss on sale? No, because I've already captured the change in the fair value. So you finally sell the asset, financial in asset at 1 lakh 4. That's it. So you sold the investment at 1 lakh 4. And apart from this, you will also be capturing the interest income. Can I say 5,000 is the interest income which goes in the P&L? We're not using the concept of EIR. So are you going to capture that 5,000 in the P&L? Yes. So a common entry for interest every year. A common entry which will be done every year. Bank gets a debit. Finance income gets a credit. That 5,000 interest which you receive every year is simply taken in the profit and loss year by year. Right, so I think that takes care of our 3 cases of the debt investments. Equity is easy. I think now I'm in a position to make a complete summary chart of all the permutation combinations on the financial assets. So far, so good, friends. I hope everything is going good. Any questions on your mind? Let's now make a summary chart based on this. I think now it's time to put some questions to you. I have been, speaking, telling you a couple of things, but when it comes to questions, when it comes to making some quick summary charts, then I think we need your active participations at that stage. Okay, great. So let's make a summary chart. Let's make a summary chart on this. This is for financial asset accounting. And I'm looking at initial. I'm looking at initial as well as subsequent accounting, all the parameters. Now, the first thing I'm going to do in this particular chart is splitting into a lot of columns. Broadly, first of all, I want to segregate this in terms of debt and equity investments. Then I'll further segregate them. So I am taking debt investments as one block. I'm taking equity investments as another block. I'm not taking derivative investments because derivative investments, is taken at APTPL, so no rocket science in that. So we'll divide the debt investments in 3 parts and equity investments in 2 parts. So either it is taken at amortized cost or APTOCI, that is R, or APTPL. This is APTOCI, this is NR, and this is APTPL. So a couple of questions coming to you now. So get active in terms of answering questions now at this stage. So let's give you some inputs. Let's make the column particulars. So 3 cases we've already done for debt investments, and these 2 cases, I think you can answer directly. I'm coming to, first of all, initial recognition. Rather, I would say initial measurement. Can I say, let's make a statement, you can vouch me, except FPTPL, fair value plus TC. Leave FPTPL, it is fair value plus TC, FPTPL, just the fair value. Correct? In all the cases except FPTPL, that's right. So this is fair value plus TC. This is fair value plus TC. This is fair value. This is fair value plus TC. And this is fair value. Let's put an asterisk. And let's elaborate this. TC charged to profit and loss. So these are the only two exceptions where the TC is not added to the financial asset. Okay, let's go further. Next, we are looking at the concept of EIR. Let's make another statement. Can I say leaving FPTPL for debt applicable? Equity, of course, not applicable. The concept of EIR not applicable to equity, but is applicable to debt other than FPTPL. Correct? So as far as EIR is concerned, that's right. So in FPTPL, no. Equity, no. And in this case, yes. So it does not apply to equity investments, and it does not apply if they are captured at FPTPL. It does not apply. Great. Next. Subsequent measurement. We're looking at subsequent measurement. Basically, I'm wanting the fair value changes. So can I say fair value changes are captured in all the cases except AC? Debt equity irrespective, fair value changes are captured in all the cases except AC. And that's rightly said. So in this case, no. In this case, yes, it enters the OCI. In this case, yes, it enters the P&L. In this case, yes, it enters the OCI. In this case, yes, it enters the P&L. Next, number 4. I'm not looking at a little later part of the things, but I'm looking at impairment. Though this is discussed later, but since we're on a revision mode, I think I'm just going to add on the inputs in terms of impairment. So can I say, let's make another strong statement. Equity investments, no impairment. Debt investments, impairment except FPTPL. Equity investments, no impairment. Debt investments, impairment except FPTPL. Correct? So when you're looking at the impairment, equity investments, outrightly no. Equity investments are not subject to impairment testing. And that's right. So they are not subject to impairment testing. And debt investments at FPTPL not subject to impairment testing, but AC yes, and this is also yes. And the impairment, just to keep a track, enters into the P&L, irrespective of the category. Now, something interesting, which is subsequent, one want to put it in a different manner. So let's put it like this, that there is an unrealized gain or unrealized loss. Indirectly, I'm linking the point number 3 and 5. I'm linking the point number 3 and 5. The point number 3 is talking in terms of fair value changes. I'm linking the point number 3 with the point number 5. Fair value changes are the unrealized gains and loss. Let's now put some quick individual questions at this stage. AC, do you capture unrealized gains or loss? In terms of AC, do you capture unrealized gain or loss? And that's right, no. In terms of OCI, yes. Where do you take them? Where do you take them? You take them in OCI. Whether it's a gain, whether it's a loss. Whether it's a gain, whether it's a loss. FPTPL, yes, and it is taken in the P&L. Whether it's a gain, whether it's a loss. The idea of putting it out here is that this is both unrealized gains and loss. This is both unrealized gains and loss. Therefore, I made a clear-cut mention. In terms of OCI, yes, gain loss OCI, yes, gain loss in the P&L. Now I want to see something more interesting in terms of the next point number 6. I'm now looking at the realized gains or loss. I'm now looking at the point in terms of realized gains and loss. Am I looking at when you sell the investments? Yes. When I'm looking in terms of the realized gains and loss, I'm looking at that you sold the investment. Now, let me make it clear, even if you hold the investment till maturity, it doesn't mean that I can't sell the investment in between. Because if I'm facing a huge credit risk, in spite of the fact that my business model is keeping investment to maturity, I might sell. So let's now come to the point. So this realized gains or loss, let me make it clear, is supposed to be, this realized gain or loss is supposed to be, you can say, on sale. When you go to sell the investments, then that would arise. So tell me, where will you take the unrealized gains or loss in AC? If you sell the investments, realized gains or loss will be captured. Captured where? Profit and loss. In terms of OCI, or yes, where do you capture? In terms of debt investments, it'll be captured where? It'll be captured again in the P&L. This, of course, will be in the P&L. And I think the interesting category is this one. What about the equity investments NR? What about the equity investments in terms of NR? I like it. This is going to be captured in OCI. This is the interesting part. Whether it is realized or it is unrealized gains, both the gains and losses are captured in terms of OCI. That's what I want to hear. And in terms of FPTPL, again, it's entered in the P&L. So I think this gives us a good quick summary chart in terms of all the permutations, combinations of financial assets, the initial measurement, the subsequent measurements, and the concept of impairments, realized, unrealized gains, losses, the concept of EIR applies or not. So we're done with the basic questions on financial assets. I've started the input in terms of financial asset accounting. I did cases on debt. Equity is easy, but we are also going to blend this debt investments with Index 21. There have been some very interesting questions which came in the RTP, so I put that in the practice questions as well. The blend of Index 109 with 21, especially when it comes to the categories of AC or when it comes to the categories of OCI. And there is a lot more to go. So we have got our next session also on financial instruments revision. So we're going to cover the aspects of some financial assets, TP, fair value differences. Then we've got the financial liabilities accounting, derecognitions concept, a bit on impairment, a bit on hedging, a lot more to go. So another power-packed session in terms of the next, that is on Wednesday, where we await for more things. But my request now, friends, is that since you've spent your time in terms of revising things, the mind maps are there with you. Please now do one thing, practice the questions from the study, from the RDPs, from the past examination questions. Once you complete the standard, go for an extensive revisions. Maybe if you can not solve all, that might be difficult, but I think still time to go. You should do all the questions, practice them well, get a complete hold on things. Because somewhere you want to put some questions in between during these revision lectures, you're ready for questions. But what happens otherwise, the topic gets over, then your questions will also be in a waiting mode. So do this, and I think that'll help. So why are we doing impairment testing for equity OCIR even though it is already recording a fair value change? Then what is the need for impairment test? I love that question. I always love that question, and I would like to answer that question as well. Number one, I want to make the intentions of the standard setters very clear to you regarding their approach on OCI NR for equity and OCI R for debt. Now, watch this carefully, a little crucial answer, but just, hear this well. In terms of the debt investments and in terms of equity, let's first understand the thought process of the standards on equity. They did not want anything to hit the P&L. I'm saying for equity investments, they did not want anything to hit the P&L. So see, watch the inputs. Since they did not want anything to hit the P&L, number one, unrealized gains loss OCI. Number two, realized gains loss OCI. Number three, no impairment, so nothing goes in P&L. Number four, even if you enter into hedge accounting for these investments, the fair value changes still enters the OCI. I gave you 4 reasons of the thought process of the standard setters. In terms of equity investments OCI, NR, unrealized gain loss OCI, realized gain loss OCI, even if you make them as a part of hedge accounting, the fair value changes don't go to the P&L. In a fair value hedge, the fair value changes goes in the P&L, but this is the only exception, it goes in OCI. And the impairment testing not done so that nothing enters the P&L. Now, coming to the part, when nothing enters to the P&L, EPS is protected forever. That's the crucial point. I made this clear in my regular sessions as well, that when you take everything to the OCI, the EPS is protected forever. But in terms of debt investments, these are investments made for the working capital of the company. And therefore, the standard setters did not want to protect from things being taken to the P&L. Even if you put the fair value changes in the OCI, EPS is not affected at that stage. But if there is a portion which is impairment and it enters the P&L, in that particular case, the EPS gets affected. Since these are debt investments, working capital needs are put in these investments, they wanted to make a hit in terms of P&L. But these are surplus money invested, so they did not want to take the hit in the P&L. That was the basic thought process of the standard setters. I hope you got your answer on that. Umang, that was a good question indeed. My favorite question, in fact, whenever people ask me the difference. Great, you're most welcome. Right, friends, I think ma'am is already there. So I think over to you, ma'am.
Thank you, sir.
Thank you,
And
ma'am.
students, good morning, everyone. Students, I hope this is the first class of your revisionary sessions, and we'll be having 20 classes. Schedule is already there on the website, on our portal. In case you want any other class also on revision, on any other topic you want any session, LVRC session to be fixed, we'll do that. Just message to us. Even you can put it on chat box, or you can also mail to me, or you have a WhatsApp group also. WhatsApp group link we will be sharing with you. And those students who have not joined our WhatsApp group for final level students, they can join that. And in case you have any suggestions or any expectations, you can put it there also. Or you can mail to us at bos@icai.in or bosnoida@icai.in. And hope I find you all find this class revisionary classes helpful, and you are taking the maximum benefit of it. Do consistency is the key, and you have to do the revision every day because we'll be having 3 classes only in a week. So you have to be on your foot. Okay. Thank you. All the best, students. Any query or any you have any thing to say, you can just put it on chat box.
Yeah, I
Okay,
think
sir.
Akhtar, you've got a question.
Sir, something you're saying?
Yeah, I think ma'am, Akhtar has a question that I have not read the textbook, yet I attend all the LVRC and read the things. Should that help? Well, I think I always tell people that listening to lectures is good, but reading stuff is also important. Your self study is also a very important element. Though all the faculties out here help you much to understand every topic in detail in the LVC as well as in the LVRC. But still, I think if you can just at least read some places where you get some confusion, trust me, the study material made by the institute is wonderfully well. Not I'm saying that because ma'am is present, but trust me, it's actually made very well. So your self study would help you to strengthen your concepts. So as a supplement, you could read at least on places where you're stuck up, but doing the questions in the study material is definitely important because they've been built on a concept by concept basis. So that will definitely help you.
I would like to add one thing, sir. See, if you go through the past question paper, suggested answers, you will find most of the questions which have been asked in your examination are from the study material only. So it is very necessary that you don't skip the questions from the study material. Definitely, at the time of revision, you cannot do all the questions. You have to mark out what are the questions which are which needs to be practiced, which have different concepts. But yes, you have to cover the study material because mostly questions are asked from the study material. Even if they are redrafting it, the concepts are already explained in the study material, and similar concepts, questions based on similar concepts are also there. So there is no scope to leave the questions practice from study material. In case students do not have, sir, any other queries students have, otherwise we can wind up the class, sir.
No, ma'am, I think that's it.
Okay, sir. Thank you. Thank you, students.
Thank you, friends. Thank you very much. See you in the next class on Wednesday. Thank you. Bye-bye. Take care. Thank you, ma'am. Hanji, thank you. Thank you. Same to you.